Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, controlling income distributions, part 3 in our series on managing your retirement. Just because you have money to burn doesn't mean you should use it yet. Remember, taxes are the #1 expense load inside a retirement plan. And you have to figure out a way to minimize that, and controlling your taxable income, your tax-deferred income, and your tax-free income is paramount to enjoying your dollars. You worked hard for it, and you shouldn't have to pay any more to Uncle Sam than you have to. I say give them every dime legitimate. It's a great country. We should support our government, but give them what they're only due. I don't want to give them one more dime. So it's up to you to manage it. Listen, if I was going into retirement and I had to learn one thing, I would learn golf first. I would learn how to play bridge. I learned a little bit of the tax code so I could manage my own taxable income, my tax deferred and tax free, and that would help me manage my tax bracket and keep more of my own money. Advantages, you know, when you're taking cash distributions, especially a lump sum, I just say, is it going to bump you into another bracket? What are the advantages and the disadvantages? Cash distribution, you can use the money immediately. You can invest and take advantage of lower long-term capital gains. The drawbacks is it's easy to spend too fast. Can I just say it will happen? Most people don't have the discipline. It's one thing to buy your retirement home with this, and you mitigated your taxable event by maybe buying it at the end of one year and the beginning of the next year so you can split the taxation issues. But I'm telling you, most people spend too fast. If you feel like you understand, you wouldn't give your children a lump sum when they're 18 because they'd buy a big car and great equipment, of stereo equipment, and all the technology that goes with tech, then you need to think about in senior we have some of the same propensities, maybe not the same motivation, but the same spending habits. So it's easy to spend too fast. Taxes are due on this money, on lump sum. It's due immediately. And no guarantee of a lifetime income because we're just taking it in cash and we're holding it. And earnings on assets no longer are tax deferred. Keep that in mind. To me, that's a powerful tool. Keep wisdom in your mind. How am I going to spend a lump sum? Now, I could take my lump sum and I could go over to an IRA rollover. The advantages are I can defer taxes until I need to withdraw the funds. And I say, I would be delaying all the way out to age 70 and a half when I have to take required minimum distributions. I would try to wait and stall. I like hybrid retirement. I like working to age 70. I believe we're going to be living so much longer. Our longevity is really going to dictate when we should retire. So if I have good health and I think I'm going to have a good longevity into my 90s, maybe even age 100, I need to start thinking about working to age 70. That just makes sense for a baby boomer. I also want to take an advantage, make investment decisions at your own pace. So now I can kind of see what I want to do. I might want to do a little bit of research. I want to kind of up my game. I always recommend staying with a financial advisor and having them escort you through the basics of investment, especially if you're still in the market. Eligible for tax-deferred growth. Yeah, I mean, I can still put this in an IRA and I still don't have to pay taxes on it because I didn't take constructive receipt of it. Some of the drawbacks, you may have to pay more taxes in the long run, but I say maybe, because we don't know what the tax brackets are. We just had the biggest tax change in almost since Reagan, and that tax change has done two things. The first thing I alluded to before was the standard deduction went to $24,000, and for seniors married that are over 65, an additional $2,500, so it's $26,500. The first is free. So I want to now look at their marginal brackets. Well, the marginal brackets came down as well. So if I have higher deductions and if I have a lower marginal tax bracket, it actually went down. That was really good for seniors. And those numbers are going to play well if you can manage when you take constructive receipt of your qualified plan. There's no guarantee of lifetime income unless you use an annuity. So the other problem is it must begin withdrawals at age 70 and a half. You're going to have to take constructive receipt. So keep that in mind because it's really important, and you want to be able to look at things that are going to be supportive in your controlling your income. Now, when you take minimum requirements, now I mentioned this before, this is it's tragic that we're dealing with seniors that are not remembering that they have to take out a required minimum distribution at age 70 and a half. If you don't do it, whatever you didn't take out and you should have, the difference between what you did withdraw and what you should have withdrawn, that number could be taxed up to 50%. To me, that's too punitive. It's just too hard to pay taxes like that. So I want you to start thinking about required minimum distributions. Keep in mind, you will be allowed under the qualified longevity annuity contract rules of 5-6 years ago to be able to defer up to 120, or actually it's 25% of your qualified plan, not to exceed $125,000. That's for father and mother. So you could actually send up, if you qualified under the numbers I gave you, $250,000 into the future. That's great. You could do it. You don't have to wait till age 85. Age 85 is when you have to start taking this money, but you could take some at 75, some at 80, some at 85 to kind of give you a step up, increasing your income as you get older. It's a great management tool. Remember, if I'm reducing my required minimum distributions using QLAC, Qualified Longevity Annuity Contract, which the government came up with, boy, think about that. If I can do that and I lower my required minimum distributions, I'm also lowering my taxes to Social Security more than likely. I could go from tier 2 to tier 1 to maybe tier none. So our goal always is to look at these rules and to make sure that they're working for us. And remember, everybody needs to know their actual tax bracket. What bracket am I in? What's my effective tax bracket? What am I actually paying at the end of the day? And if you go back to your actual total revenue against the total taxes you paid, state and government, you'll have an idea. Remember, taxes are the largest expense in retirement. And so when I'm looking at it, I want to make sure that if I'm going to make a calculation, I'm going to add up all my IRAs, all my qualified plans, anything that's ERISA. And I still say, even though I could teach you how to do this, I say don't make a mistake on this. Make sure you're being escorted through your RMDs, your required minimum distribution, with a financial advisor, somebody that's really good and their expertise is in retirement income. And I always like when they also have a kind of a side area of expertise, taxation. So figure your withdrawal amount, get the numbers right. If you have $250,000 in your IRA and you have a distribution period of 20.3 years, you'll need to withdraw $12,315.27. And you can use this formula below to figure out your size of your withdrawal. And if you say, Steve, I'd love to get this calculation, if you'll write me at steve@lifesizesolutions.com, I'll send you the calculation. But again, I exhort you, even though I'm giving you the way to do this, I want you to really think about using a financial advisor. I want to avoid penalties. I already told you 50% of all the money that you should have taken out could be a penalty tax. That's just too great, and I don't want to have to worry about that. And remember, I'm going to be making my decision on what I'm going to take out, what I have to take out, and what I'm going to take out. Remember, we have a lot of money still in non-qualified areas where we don't have to take constructive receipt. If I can push that and defer it a bit and send it into the future, I want to do so. So keep in mind, I need to make sure I know where my cash resources are, and especially as it relates to now I'm trying to control my income. I'm trying to match it up with my taxes. If I'm really good at this and I school myself when I come into retirement on the basic issues of taxation, I promise you, generally speaking, we can increase a client's actual income, take-home, net spendable into their pocket income by about 10 to 15% just by managing a few issues on their taxes. To me, 10, 15% could make the difference between living check to check and month to month every month and having a little bit of cash flow and a little bit of fun discretionary money. So it's really, in my view, a very huge idea to think about it. And when I'm managing withdrawals, I kind of want to try to figure out this basic idea that when we're managing withdrawals, there's 3 basic ways. And what I like to do is, again, review. I could take it lump sum, I could take it as needed, and I could take it, no, I'm going to take a regular scheduled income. I don't know which one feels right for you. When Goldilocks sits down, she might think that's too hard, I'll spend it. She might sit down here and say, but I think I need more or I don't need less. I don't want you to live in poverty. I don't want you to live with a mindset of that you have to really skinny back your lifestyle because you're afraid that you won't make it all the way out. And by the way, there is some legitimate issues. If we're into debt, we need to get rid of our debt service first before we were talking this way. But just remember, that's why I want you to think through before you have gotten into retirement. Of course, this whole series is about being in retirement already. So lump sum, you could take it as you need it, or you could have regular schedule. Again, my advice, because most of us are not really disciplined, I'm going to take my Social Security and a joint annuity and match those 2 incomes against my essential spending and my discretionary spending so that I already have something guaranteed for life and my annuity has a little bit of a COLA attached to it. And of course, I'm hoping that Social Security will also pay a bit of a bump every year. And it hasn't, 3 years of the last 8 years, it hasn't, but 5 years they have a little bit, not a lot. So you want to look at 3 ways to withdraw: lump sum, as you need it, or no, I'm just going to schedule it and make it automatic with my Social Security. Don't forget to watch our next segment on minimizing your taxes, part 4 in our series on managing your retirement. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.
Oh my!